If you want to reduce your taxes down to zero, you have to use the right framework. I call it the 4 S's: structure, search, shift, and shelter. You have to structure how you earn income, search for all of the deductions that you're missing, shift income to create even more tax deductions, and shelter the rest of your income away from being taxed altogether. This has been studied and is exactly how the richest Americans avoid paying taxes, and also why we see billionaires paying close to 0% of their total wealth towards income tax legally without committing tax evasion or tax fraud. And as a licensed CPA that tax plans every day at mycpacoach.com, I am going to show you exactly how to reduce your taxes by literally however much you would like to by utilizing the tax code to your benefit. So go ahead and save this video, hit the like button below, and let's go ahead and jump in. Now, as we go through this, remember, income tax is based on your income. So if we can change how that income is reported on your taxes, like the type of income it is, or if we can find ways to report less of it through deductions, we can pay less taxes, or in some cases, even zero. Now, your ability to reduce your taxes to zero will depend on what you're willing to do and what you're able to do. Someone might be able to reduce their taxes to zero with just 2 or 3 key strategies here, but keep in mind that this will depend on what you're willing to do and what makes sense for your unique situation. But regardless, in almost every situation that I see, there is always something you can do. And even if it does not reduce your taxes down to zero, you might still benefit from moving down a tax bracket or two, like being taxed at 10, 12, or 22% instead of 37% plus state taxes. We just want to be smart about our taxes here. So let's go ahead and walk through our framework in order to do this, starting with the first S, which is structure. This is going to be your foundation. The structure in which you earn income will directly affect your taxes because the IRS taxes different types of income at completely different rates. Let's illustrate this using the Rich Dad, Poor Dad cash flow quadrant, which shows the 4 ways to produce income. So when you are an employee, you pay the highest rate of taxes. You pay ordinary income tax up to 37% federally, plus payroll tax like Social Security and Medicare at 7.65%, plus state taxes. And here's the kicker. You cannot write off any of the expenses you incur to earn that income. Your home office, your car, your equipment, none of that is tax deductible until you move to the next tier here, self-employment. And suddenly, those ordinary and necessary expenses that you incur to earn income becomes tax deductible. But the downside here is that you are now paying a 15.3% self-employment tax, which is twice the amount of payroll tax you would have to pay as an employee. That is, until you convert that income over into corporate income. When you structure your business as an S Corp or C Corp, you eliminate that 15.3% self-employment tax completely. Plus, you may also be able to reduce your taxes through a corporation because they are able to take a few more tax deductions and can also choose to be taxed at a lower rate of 21% if you elect to be taxed as a C corporation. But from a tax perspective, the single best type of income to earn is typically investment income, like qualified dividends or long-term capital gains. These income sources can be taxed as low as 0%. I repeat, 0% depending on your income, and those rates can go up to 20% as well, which is still much lower than ordinary income tax rates. So here's my point here when we talk about structure. In order to reduce your taxes, you have to optimize your income sources for the most tax efficient treatment possible. As you move across these quadrants, you get more opportunities to reduce your taxes. But that does not mean you have to jump through every quadrant. An employee could invest in real estate and use real estate losses to offset all of their W-2 income, while a business owner could focus purely on entity optimization and their tax deductions. The key is choosing the structure that gives you the most tax-saving opportunities based on the primary way that you earn income or plan to build wealth. And once you have the best structure, then you can move on to the second S here, our search for all missing tax deductions. Now, this is typically the lowest hanging fruit for anyone who wants to reduce their taxes without spending or investing a whole lot of money. Tax deductions reduce the income reported on your taxes, which means the more tax deductions you can find and take, the lower your taxes will be. With this search step, we simply want to look at all the places where your money is going and what expenses you have that may qualify for tax deductions. For regular individuals, we're typically looking at itemized deductions that may exceed your standard deduction. So like the student loan interest deduction, mortgage interest, state and local taxes like property tax, medical and dental expenses you have, or donations you make, and so on. So many people have these expenses but fail to write them off on their taxes, and you don't want to be one of them. But then for self-employed individuals, business owners, and active investors, we can go even further to see what expenses that they may have, which may also qualify as a business tax deduction. Generally speaking, the tax law allows you to write off the business usage of any personal expense that you might have. So we will look at all of your home expenses, cars, meals, travel, health insurance, education expenses you might have, and more to see if we can write off any portion of those expenses as legitimate business deductions. And this usually presents planning opportunities for individuals like this to find ways to associate a business purpose with some of their largest personal expenses to make them eligible for tax deductions. So once you're earning income within the best structure possible, go ahead and conduct a search for all deductions you may qualify for, or take it a step further and find ways to make your largest expenses eligible for tax deductions within the tax rules. Now, the third S is one of my personal favorites: shifting income to create tax deductions. This is where we shift income into different buckets that are subject to lower tax rates. There are three main buckets which may allow you to do this: yourself, your family, and other entities. So here's how it works. When you operate a trade or business, the IRS allows you to take deductions for legitimate payments in exchange for services that your business receives. So as the business owner, you can create arrangements where your business pays someone else and you are granted a tax deduction while the recipient pays little to no tax on what they receive. For example, you can shift income to yourself with strategies like the Augusta rule, which allows you to rent your home to your business for up to 14 days per year. With this, the business can deduct the payment, but it is tax-free to the owner. You can also set up something called fringe benefit plans, which are used to reimburse yourself tax-free for certain medical expenses you have, child care, education, and other business expenses that you may pay for personally. It is also very popular for business owners to set up arrangements to shift income to their family members. Usually with this, we are looking for any kids, parents, or family members in very low tax brackets that we also support. And if the person you pay earns less than the standard deduction amount when they file their taxes, they would owe zero tax while you get a business deduction. And even if they do earn more than the standard deduction, keep in mind that they would be taxed at lower rates starting at 10%, which can still be very beneficial for someone in a 30% tax bracket or above. Outside of that, you can also set up entities to shift income to. You may be able to move some of your income into a C corporation to have it taxed at that flat 21% tax rate instead of a higher tax rate, assuming that you're using those funds to reinvest into something else. You can also shift income to nonprofit organizations that you own and control, like public charities or private foundations. When you set something like this up, your donations to that foundation are tax deductible. The foundation, on the other hand, pays 0% tax as a tax-exempt organization, and you can still control how that money is being used. These are all ways in which you can shift income to create tax deductions that in turn lower your income. But then there is the fourth and most valuable S here: sheltering income. This is the single greatest way to reduce your taxes by however much that you are willing to. When we park income in a tax shelter, that shelter shields that income from being taxed. Sometimes the tax is just deferred to the future, and sometimes the tax could be completely eliminated. And as a CPA, what I view as a tax shelter are things that are IRS approved, okay, and are literally inside the tax code. So let me break down the 5 most powerful tax shelters that I use with my clients. So number 1, we have tax deferred accounts, which is the most basic form of tax sheltering. These are things like IRAs, 401ks, HSAs, and pension plans. Typically, you can get a tax deduction for putting money into these accounts while also benefiting from tax-free growth inside those accounts. And in some cases, you might even qualify for tax-free withdrawals. Then there's number 2, real estate, like rental properties or business properties. When you buy properties like this, the tax law allows you to take a very large amount of depreciation against your purchase, which can offset a large portion of your income. For example, I had a client with about $140,000 in income who bought a $500,000 rental property that was able to take $150,000 in depreciation deductions against it to completely wipe out his income, and also paid 0 taxes as a result. To do this, he used certain IRS rules like the real estate professional tax status, which allowed him to use real estate losses to offset his W-2 income. And also keep in mind that there are a few other loopholes and IRS exceptions that may allow you to achieve similar results like this. So just drop a comment below if you would like to learn more. But real estate is not the only thing you can do. There's also number 3, business reinvestments. So when you own a business, that business can also be used as a tax shelter. Every dollar you reinvest back into it for things like equipment, machinery, more advertising, employees, and so on, can reduce your taxable income dollar for dollar. And when there is not an immediate plan for those funds, you could also structure it as a C corporation, which would allow you to leave profits in the business and only pay the 21% flat corporate tax rate, which might be less than your personal tax rate, which we already saw could be as high as 37%. So this may allow you to save over 15% on every dollar that you keep and reinvest back into the business. Another big tax shelter we see is number 4, oil and gas investments. This one is typically for accredited investors, but it is powerful. The tax law allows you to write off up to 85% of your original investment in the first year when that business conducts drilling operations. So if you invested $100,000, you could potentially write off $85,000 immediately. So someone in the 37% tax bracket would save over $31,000 in tax savings in the first year. But also keep in mind that these investments do come with risk, so you will want to make sure that you do your homework. And then there's the 5th and final tax shelter, charities. Now, this is how the very wealthy play the tax game. They set up their own private foundations or donor advised funds in some cases to create these very large charitable tax deductions when they move money into it. And usually they are able to control how that money is actually being used. And inside these foundations, they are able to take their own salaries, employ other family members, write off expenses for things like travel and meals for board meetings, and do much more, while the rest of the income left in that foundation is exempt from being taxed altogether. So the tax benefits of this is clear, but generally speaking, keep in mind, whenever you create a nonprofit or a foundation, it does have to conduct some type of charitable activity. If it is a private foundation that primarily gives money, then typically that foundation has to donate a certain percentage or amount of its assets each year to remain compliant. So be very careful with this and consult a CPA if necessary. But now let's bring everything together and answer the main question of this video. How exactly can we pay 0 taxes? And it's very simple. Choose the best structure to earn income within, search for every available deduction to bring that income down, even if that means shifting income to move more money or income off your tax return, and then shelter the remaining income away that you do not want to pay taxes on if possible. Now, how this is executed will look different for every person watching this, but the process is the same if you want to reduce your taxes by as much as possible. And if you need help implementing strategies that are guaranteed to reduce your taxes, just apply to work with my team today at mycpacoach.com.